Welcome back. In the previous video, we talked about the difference between promised and expected rates of return, also called credit risk. It's a first-order consideration. In this video, we want to look at the real world and see how credit risk manifests itself. So, credit scores, first, they estimate how likely you are to repay your loans. Most everyone has a credit score. To lend you money, most commercial lenders must check your score as part of their due diligence. They don't have a choice. Now, a credit score is just one number, one statistic. It cannot cover many different dimensions. So it is not very good at distinguishing between, say, 80% repayment or 0% repayment. It is not very good at distinguishing, are you likely not to pay back whatever you borrow immediately or just in the very distant future? It's also not very good in distinguishing between in ordinary times versus extraordinary times or extraordinary circumstances. It's just one number. So here is, for example, the Experian classification. Virtually everybody has an Experian score. This is the most prominent credit score provider. If you have a score between 300 and 580, you have a very poor credit score. Only 13% of the population have this. If you have a score of 800 to 850, your credit score is exceptional. Only about 22% of the population have this. There are also other credit scorers like FICO or Equifax. Companies also have corporate credit ratings just like you do. There's three big rating agencies, Standard & Poor's, Moody's, Fitch. They have ratings that are in two big categories. The first one is investment grade. The second one is, obviously, non-investment grade. That one has a more common name called junk or high yield. Now, there are some legal differences that are a little bit weird. So it turns out that many funds are only allowed to hold investment grade bonds. There's no particular reason why that should be so, but this is just the rules. The finer categories from these three rating agencies have names that are somewhat bizarre. Even I usually look them up, but this is how they roughly look like. Moody's, AAA, this is the best that you can possibly get. That goes all the way up to Baa1. And then come the non-investment grade. They range from Ba1 to C. For S&P, it starts with AAA and ends at BBB+. Those are the investment grade bonds. The non-investment grade bonds start with BB+ and go down all the way to D. And Fitch is almost like S&P. For example, the University of California, which was just raising a $2 billion general revenue bond, which is tax exempt incidentally, has a Moody's rating of AA2. So that's a very good, very highly rated bond. It also has a very good rating from S&P. It's AA. Apple is even better, has an AA+. Google is about the same as us. Facebook is a little bit worse. Tesla is a lot worse. Now, default is defined by those three credit rating agencies as failure to pay at least one payment on time. The typical AAA bond does not default over the first 10 years. The typical B-rated bond has a 20% probability of at least not making one payment, and the typical C firm has a 50% probability over 6 to 8 years. I've also put up a figure that gives you a better idea years after issues being on the x-axis and the mortality, that is not actually making one of the payments, on the y-axis. And as you can see, the CCC bonds, you get a pretty substantial probability that you will not get everything that you're promised. But it gets even more interesting because all bonds are less likely to repay in recessions. So we had a recession in 2000, we had the Great Recession in 2008, we had another recession in about 1990. So during those times, there were far higher losses if you had lent your money to corporations than, say, to the US Treasury. Now, how did credit risk influence yields? And what were promised yields and expected yields? These are not easy to answer or decompose for that matter, because bonds with credit risk pay not only the credit premia, but also all the other premia like risk premia, liquidity, resellability premia. People also just like the name of the US Treasury more than they like the name of Joe Schmo. We can use historical data to estimate this, although we will never get it perfectly correct. So here are typical premium magnitudes. Without a default premium, 0 defaults, there's of course no risk premium because there isn't any risk. Without a risk premium, there could be a default premium, compensates you for default. In fact, this is what we're just talking about. The default premium is usually bigger in magnitude than the risk premium. Not necessarily and only probably, but probably. So in rough terms, over a sample that I've looked at, well, not me, but some researchers, US Treasuries paid about 2% per year on average. AAA bonds promised about 2 to 5%. BAA bonds promised about 4 to 6%. So I would guess that about 1 to 1.5% of this is credit spreads on the AAAs. About 3 to 5% is credit spread on the BAAs. So you are not likely to get them on average. You only get those numbers when everything does all right. This is not a perfect measure. It's also time varying. There are different times where the credit spread is higher or lower, but just an over-the-envelope idea. So if you look at the average rate of return, AAA rated bonds had a rate of return above the Treasury in this particular sample of about 0.7%, single A rated bonds about 1%, BAA bonds about 1.5%, and B1 bonds about 2 to 2.5%. So that explains a good part of the difference between the AAA rated, BAA rated bonds and the US Treasury. There's also a difference between short-term and long-term bonds. Short-term treasuries paid about 1%, long-term treasuries about 2% in this sample. So if we look at this, for very short-term notes, it's usually relatively easy to assess whether there's a default likely to occur. Not many AA bonds immediately go bankrupt within a few months just after having issued. So there's going to be a very small credit spread here, and it was typically only about 0.5%. For long-term bonds, this was higher. It's much more common that over time, bonds become more likely not to pay. So if you look at this, the actual premium that you get, your risk aversion, liquidity, all these others, which are really average above the treasuries, was only about 50 basis points for short term and about 130 basis points for long term. This is primarily for highly rated investment grade bonds. So what do we see when we are promised a higher yield to maturity for a corporate bond than what we would get for the equivalent treasury bond, which is what we would really see if we look today. So I've looked at a particular fund, VLTCX, that is a Vanguard fund that holds many different long-term corporate bonds. It's an index fund. It's not very active. It's very low trading fees, very low transaction fees. That on February 10 had a yield to maturity of about 5.13% on its average bond. The 10-year treasury stood at about 4.5%. So the difference between these two is about 60 basis points. And we can argue about the transaction costs, but order of magnitude 60 basis points. What is it that this is compensating you for? Is it fair compensation? We won't know for a long time, if ever. The 60 basis points clearly has a very large credit spread component to it. Now, US Treasuries are also exempt from state income taxes. So the 60 basis points actually also has to compensate the VLTCX investors for not getting that tax premium. They have to pay more taxes than holders of US Treasuries. There's also some prepayment premium. It turns out that issuers usually can prepay their bonds the same way you can prepay your mortgage. And if the rate goes down significantly, many of those issuers are likely to do that. So in order for you to be willing to buy these bonds, the issuers of these corporate bonds also have to give you a few extra points for that feature. So my guess is that those two together with the default premium are probably going to cover easily 50 basis points. Your risk premium here is probably no more than 10 basis points. So true compensation for risk bearing is very small. Would you likely wish ex post after the fact that you had put your money in US Treasuries rather than credit risky corporate bonds in recessions or in expansions?
Please pause this video now, answer the question on a piece of paper, and then continue.
Well, more likely in recessions. That's when companies are more likely to go bankrupt. Here's another question. How should you hold risky debt? Your 401k, that is a tax-preferred account in which you can accumulate resources for when you retire, your pension brokerage account, accumulates capital over time, and usually as people get older and older, it has a lot of capital accumulated because it has to last people for a whole lot of retirement. Similarly, there's a lot of life insurance companies that have tax-exempt accounts. For you, it's the 401k. So your 401k is tax-preferred. It doesn't have to pay tax on interest receipts as they come in. Of course, you may still want to hold bonds or other things rather than US Treasuries because you get some extra return. On the other hand, maybe not too much because you fear poor performance and may prefer playing it safer. But here's the deal. If you want to hold any interest-bearing bonds, then you should do so in your tax-preferred vehicles first. Let me go back to bigger markets for a moment. Institutions have another interesting financial asset that they can buy, and you may not suspect what it is. This is called a credit default swap, abbreviated CDS. This is an agreement, a side bet between two parties, say you and me, that in the event of default, whoever sold the CDS may either pay the CDS buyer a fixed amount or allow the CDS buyer to sell the bond for a pre-agreed price to the CDS seller, which is usually the price as if it hadn't defaulted, upfront, but only in the event of default. So most of these CDSs are standardized now. There's a few unusual ones that can be negotiated upfront. Most of them are standardized. In 2021, there was more than $10 trillion of single name, that means individual companies, single name credit swaps outstanding, in which one party would pay another if the firm failed to pay its promised coupons or if it went bankrupt. Now, the true market size, however, is hard to assess because if I own credit default swaps 10 million long and $10 million short, it may or may not be counted as zero. What makes the CDS so interesting is that it divorces the risk of credit from whoever gives the capital. So a life insurance company may give the capital, they're good at this, but they may not want to hold any risk. They are not good at assessing risk. They are good at collecting premia, investing it for a while, and then paying what they owe to their policyholders. Believe it or not, what can sometimes happen is if an obscure savings and loan company in Germany writes a CDS over some housing bonds in Kansas, and there's all of a sudden housing trouble in Kansas, it may be the German it may be the German bank that is actually on the hook here, and the German bank that can blow up. There's even weirder things that can happen. A hedge fund can buy a lot of CDSs and buy bonds with the intent to have a voice in bankruptcy court or close to bankruptcy, and intend to push the firm into more distress in order to collect a lot more money from the CDS payments. Now, here's another little problem. As a buyer of a credit default swap, you also have to worry about whether the issuer of the credit default swap will make good on the promise and not go bankrupt itself and not pay up. This turns out to have been a big deal in the financial crisis of 2008. There were all these banks that had actually bought credit default swaps, thought they were perfectly safe, and then found out that the company AIG, an insurance giant, which had actually sold all these CDSs, primarily so that their traders could get very rich because they got a bonus based on how many credit default swaps they sold, they found out that, whoops, AIG is bankrupt. And what the government had to do in order to save a lot of these banks, they had to bail out AIG. Well, who's the government? The government is really you and me. So we had to bail out AIG. The traders of AIG made a lot of money, and that prevented some more of the financial crisis from spreading, not only in the United States, but also in Germany and in many other places. Since the 2008 financial crisis, a clearinghouse was set up to reduce counterparty risk, which also gives regulators an idea to have an overview of the market. It turns out in 2008, 2009, all the regulators were sitting around and were trying to figure out where's the risk in the economy, who can blow up. And they had no idea because the CDSs had shifted all the risk around. Today, CDS buyers are typically mutual funds or pension funds which want to reduce their risk exposure. The sellers are typically hedge funds who want to speculate on firms not going bankrupt. They have an expertise, they have a specialty of running quant models to model this much better. That's the reason why they want to speculate on it. That's it for this video and for how financial markets have evolved to deal with credit risk. In the next video, I'll explain the differences between debt and equity. See you soon. Bis bald.
Why didn't you report your stolen credit card?
The thief was spending less than my wife.
Then why are you reporting it now?
I think now the thief's wife has started using it.
Wifist.